Hi everyone, welcome. I'm Jason from Cake. This is Stuart Williams from Deloitte. We'll be your hosts for today. Just give a minute or two for people to enter. Thanks for joining. We had 75. We just came up with this idea about a week ago. We thought, hey, like there's a reporting deadline coming up, and it'd be nice to share some insights to help help you guys. We recently made a feature in Cake to help you get the data for that as well. So we thought, hey, let's make sure that we're doing our best to help everyone get this right. And 75 registrations. So obviously relevant topic, and looking forward to sharing some insights with you today. I'll be a little bit of a passenger and a learner today somewhat as well, because we have Stu here to help us understand the bulk of things. Welcome, mate.
Indeed. And thanks for having me along, Jace. Appreciate it.
Sweet as. It's good to have smart friends. So I really appreciate you being here. Um, yeah, so we've got about 20 here now. So we'll just give everyone another minute or two to come in, just so they don't miss things. But Stu and I, we've known each other for a little while. Hey, how long have you been doing employee, related matters at Deloitte? Tell us a bit about yourself and your background, Stu, while people are joining.
Yeah, sure. So I've had a bit of a checkered career in terms of what I've done. I started off about 20 years ago and I was in expat tax and moved into employment taxes, and I've done everything under the sun on that front. And then a number of years ago moved across and have been working in share plans, etc., for a number of years now. So I actually head up the equity and incentives practice for Deloitte on a national basis. So what we do is anything from design, implementation, legal drafting, regulatory reporting, anything to do with share plans is what we do. And I'm lucky enough to have a great team who works with me across the nation. So yes, we've spent the last couple of months trying to get stuff out for the 14 July deadline, and there have been a couple of late nights, but we're nearly there, and hopefully everyone else who's on the line is too.
Awesome. No, thank you. We're really grateful to have you here. You've got a wealth of knowledge. As most of you will know, at Cake, we like to make things, simpler and faster and more streamlined. And the software is very helpful, but it does reach its limits when, in these technical matters. And we love to partner with, people like Stu and organizations like Deloitte and others to make sure that you're getting that, that support, that advisory support, around the software. And it's a perfect balance for making sure all your equity matters are well looked after. So so some of you guys will be Cake customers, some of you won't. We're absolutely cool with all that. But we're very grateful that you're here. I'm one of the co-founders of Cake. We do equity management software, as you probably know. So from cap tables to employee equity. So how we're going to run today is we're going to have somewhere around 15 minutes or so with Stuart talking us through some of the technical elements of ESS reporting and some sort of related matters. We would love it if you ask questions along the way. Just chuck it in the chat. I'll be monitoring that and just seeing if we can tick them off as we go, or we can pick them up at the end. But it's you're here to learn, right? And you've probably got questions on your mind, or you wouldn't be here. So it doesn't hurt to put them in the chat. If not, I'm going to poke some buttons at the end and see if I can get some questions. So we'll do a bit of that, and then I'm going to show you a little bit around the reporting functionality in Cake, just so you know how to use it. And so if you're already using Cake, you'll know how it works, because it's a new feature. And if not, at least you get to see what it is and assess whether it could be useful for you. So without further ado, I'll hand over to you, Stuart, and we would love to learn more.
It's been a long time since anyone's called me Stuart, Chase.
I thought you'd like that.
Yeah. Wanted to run through some basics first, just to make sure that we're all on the same page in terms of when ESS reporting is required, and get into some of the more common questions we get, or the scenarios that we're dealing with come this time of year. So starting point with ESS reporting is always, do I actually have an obligation? And ESS reporting is only required to the extent that you have employee share scheme interests that have been subject to a taxing point. Now, one of the key aspects is, have I actually got a discount in relation to the instrument that I have granted? Because if you don't, then you probably don't have an ESS reporting obligation. So, loan funded share plans, premium priced options, those sorts of arrangements generally don't fall within the ESS reporting provisions, whereas anything that is granted at a discount should actually be subject to reporting. There's a
So that would include ESOPs, right? So when you say ESS reporting, that would include what? Share schemes and ESOPs and RSUs and all those types of things all under that banner? Yeah.
Right. That's right. That's exactly right. Other things that might fall out might be, if you're issuing units that don't convert into shares or, synthetic instruments that are cash-based, they would fall out. But anything equity related that is at a discount will generally fall in.
Cool.
So in terms of the timing of it all, there are obligations. So outside of your single touch payroll reporting that you'd ordinarily use for your salary and wages, you do have this obligation to provide statements to your participants by the 14th of July after the year in which a taxing point arises, and you report to the tax office by the 14th of August again. I would call out the fact that there are penalties for late lodgement. A lot of companies do tend to leave this into the last moment. And equally, some taxing points don't arise until the very back end of June. So the information that is required in order to complete the reporting can come late in the piece. But just calling out, extreme example is if you're a significant global entity, over $700,000 worth of penalties that can be imposed if you miss a lodgement. Obviously, that's scaled back if you're a smaller entity, but just calling that out. And in terms of the penalties, the bigger penalty is actually the harassment from your employees and staff and not getting their statement if you don't do it, because they'll be expecting it to get their tax returns done. In terms of the obligation around the reporting, it does fall to the provider. So the provider is the entity in which the shares or the rights to shares are granted. So it doesn't actually tie to your employer. It ties to that provider entity. So if you have, two different employing entities, but every participant is receiving shares in the headco, it's actually the headco that's got the obligation to report. And in the context of international plans, that would ordinarily be the overseas headco. However, that being said, the ATO does accept that so long as there's reporting done at the local level, that's usually satisfactory for their purposes.
Oh, that's good news. Yeah. A lot of us will have an operating entity and an investment entity, potentially as separate entities.
Yeah.
So you're suggesting that the operating entity can be the lodger, because that's normally the one that's doing all the lodgements.
All the grants. Yep, that's right. Yep. In terms of who can actually do it, so you can do this yourself. There is an ability for you to submit through the tax office portal. A lot of clients do that, but it is limited in terms of the number of participants you can have in there. So it's limited to 50 people. Outside of that, you do need to either develop your own specific software in order to lodge, or use a third-party provider such as Deloitte. What we tend to find is that even if you can lodge it yourself, a lot of clients, because of the nature of ESS reporting and the amount of data that needs to be collected, they tend to want to outsource it anyway from an administrative ease point of view. But that's not saying that you can't do it. You can do it through the ATO portal and all the websites. The ATO website gives you details around that, so check that out. I always get asked as well, do I need to report in respect of startup concession plans? And the answer to that is yes. And it's actually critical that you do, because a startup plan inherently is taxed at the date of grant, but there's a zero value that's taxable. So what you are doing by reporting to the tax office at the date of grant is informing them that you have set the cost base for the asset for future growth, which is then subject to CGT. And you start the clock on the 12-month rule for CGT discount, and also the 3-year clock for the purposes of that minimum holding period that's required for startup plans. So really important that you get your ESS reporting in for startup concession plans. And if you're outside of startup concession plans and you're into, tax deferral, etc., then it's about determining whether or not you have a taxing point in that year. Was there an exercise? Has someone sold something within the year? Making sure you're picking that up. In terms of where you report on the statement, the way I always think about it is going back to basics. You need to look at the type of plan that you're operating, because fundamentally that will decide whether or not it's subject to upfront taxation with a reduction, without a reduction, or whether it's subject to deferral, or whether you're in startup shares or option territory. So you need to start with the plan rules, determine whether or not you're in one of those buckets, and then you need to overlay the participants' personal facts and circumstances. So, really common case is you've got what would otherwise be a tax deferred scenario, but a participant holds more than 10% in the company, or has the ability to vote for more than 10% in the company. In that scenario, taxation actually occurs at the date of grant, and you would need to report in the year that the grant is made. It's just slightly different because of the personal facts and circumstances of that participant. In terms of the value that we use.
Yeah. So before we go on to the value,
Yeah.
I've got a copy of the actual employee share scheme statement here.
Yeah.
You mind if I just pop it up and then we just like briefly talk through it? Because,
Yeah.
some people probably haven't, might not have done this before, might not have even seen one of these things before.
Sure.
Sorry for those of you that are already familiar with this. We'll try not to sort of stick on this for too long, but I thought this could be, just a good touch point. So is it worthwhile just maybe highlighting a few things on here that might be contentious or complicated?
Yep. So I think the first part would be that box D. So taxed upfront, eligible for reduction. One thing to point there is that when you're disclosing the full amount of the discount that's provided to the individual, you don't take into account the $1,000 discount. So you don't report the net amount, you actually report the gross amount, and then it's up to the individual in their filing of their tax return to apply that discount. So just make sure, again, that you're putting full amount of the discount in box D. That would be for things such as, your $1,000 reduction. Not eligible for reduction in E would be, quite often we've got ESPPs, employee share purchase plans, that are taxed at the date that the purchase arises. But they, as an example, if you've got, US entity that's granting and they don't abide by the 3-year minimum holding rule, then you would not be eligible for the reduction. So you push that into box E. Deferral is, as you would anticipate, rights that have a real risk of forfeiture, or are subject to a disposal restriction on grant and have particular wording in the plan rules. They would all defer out until a future point in time. And then in terms of TFN amounts, I have seen this used maybe once in my career. As you're probably aware, employee share schemes don't require withholding unless the participant has failed to furnish their tax file number or their ABN to you. And so if you are in that situation, you do have an obligation to withhold. But practically speaking, so long as you've got the TFN from the individual, you'll never populate anything into box C. And the only thing I'd call out on the startup concessions would just be around when they talk about the market value of shares acquired, it's not the individual price of the share or the individual price of the market of the option. It's actually the total value that has been included. So what you're looking to do here is say, if I bought 100 shares for $100, it's the full $100 that you've paid to acquire them. And if they're worth 200, then the discount is the $100. So full value that's included in that market value there. Sorry, I saw another question pop up as well. Can you speak to the handling of staff who are not employed in Australia? The reporting rule is different. They don't have a tax file number. Yeah, that's right. So if we're talking about staff who are not employed in Australia, so the question was, if people can't see, can you speak to the handling of staff who are not employed in Australia? Are the reporting rules different given they don't have a TFN? What I would say is if someone is outside of Australia and employed by a foreign entity, the first thing I would be wondering about is, are they actually an Australian tax resident? Do they fall within the employee share scheme provisions? Because if they are a foreign resident and have been for the full period between grant and vest, and they haven't returned to Australia during that period, then you would have no ESS reporting obligation. If you hire someone in the US and they're always over in the US, there's never going to be a reporting obligation because they're not subject to tax in Australia under our usual sourcing and taxability provisions. But if you do have someone who's overseas, and they are an Australian resident and they don't have a tax file number, which might be a bit of an unusual situation, but if you did have that scenario, then yes, you would need to withhold and include that TFN withholding in there.
Cool. Thanks for that.
Okay. I was going to jump into some valuations bit, unless you had anything else, Jace. You're right.
Perfect.
Cool. So in terms of valuation, the key around vals is that there's no statutory guidance around how to determine market value other than in the context of unlisted rights. And so it takes its ordinary meaning. Now, again, I'll kind of split it into startup versus non-startup. In a startup environment, the tax office has released a legislative instrument that allows you to use certain safe harbor valuation methodologies subject to meeting particular criteria. And so you can use a net tangible asset valuation methodology in order to value your shares if you meet those criteria. That tends to be really concessional. And if you haven't looked at that previously, would absolutely recommend that you do have a look at that. If you fall out of those safe harbor provisions, then there are alternatives. So if you are an unlisted company, director's valuation or a third-party valuation can be undertaken, so long as the director's val is undertaken by someone who knows how to do valuations. Usually, we would see that being done by a CFO, and then or a third-party valuer obviously can be used. And then in the context of a listed entity, share price is obviously going to be readily available, but you are not pinned down to one particular value. So you might take opening, closing, 5-day VWAP, lowest price for the day, average. What the ATO is looking for in the listed environment is more so consistency in terms of the approach that you take on an annual basis, as opposed to one particular market value. The only other thing I'll call out on value is in respect of cap raises. So quite often clients will come to us and be making assertions around a value for reporting, but they might have had a cap raise which was relatively recent. Now, obviously, market value changes over time, and what you raised capital at isn't necessarily the value it is, at a future point in time. But equally, if the tax office does look at it and they're close together, you would need to have strong support as to why that market value has shifted if it's in a direction that's beneficial for taxpayers.
Just a quick one. If we've done the valuation section, can you see that one from Alex? I'll just call it out so everyone can hear. So Alex has said, just to be clear, this is going back to the previous point, assuming startup concessions apply and we've granted options with a 0 discount on strike price, we've got no obligation until such a time where exercising happens.
No, so in a startup scenario where you've issued a market value option, then you do have a reporting obligation for the 14th of August in terms of the annual report to the tax office for the year in which the grant occurs, so the year after. So if you had it in on the 29th of June 2024, you would need to, the grant was made 29 June 2024, you would need to do 14 August.
Even if there's no discount.
That's right.
Okay. Thanks for clarifying that. And then there's a new question from Stephen. Thank you, everyone, for your questions. Very helpful. If an investment round was recently completed at a set price per share, say $1, can the shares be issued to key employees and/or independent contractors using the ATO valuation method for some or all of the internal team versus external investors? So I think what they're saying there is, can you have the strike price on the option be below the price of the round? And the answer is yes, but do you want to talk through the specifics of that?
Yeah, so in a startup world, that for the startup concession to apply, you do need to have the exercise price equal to the market value of the underlying share on the date of grant. And so given the importance of getting into those startup concessions, I would always flag, if you're going to use a different value, you absolutely need to have documentation sitting behind that to be able to justify it. But if you're outside of the startup concessions and you want to issue, an option with an exercise price that's lower than a cap raise price, that's completely fine. It just becomes a commercial decision as to the value of the instrument that you want to deliver to the participant.
Yeah, from my perspective, that valuation, if you're under the startup concession, we call that an NTA valuation or a startup concession valuation. And in real world terms, because a lot of us are doing software, you might be raising at $1 a share at, say, a $10 million pre-money val. You might only have 500 grand in the bank. So, then NTA could be 5 cents versus the versus the $1, and then you can, this is not tax advice, but just in general principles, that is the market price. So under the startup concession, this is the concession. So the market price is set at the net tangible asset price, as opposed to the price that you're raising capital at. And that's a big part of the benefit of the concession, as well as the deferred tax. So yeah.
And it allows you to provide greater value to the participant, obviously, because they've got a lower exercise price and more of the gain is held on your capital gains tax account when they ultimately sell.
Yeah. And you don't have to do that as well. Just talking through the principles of how you want to use it. You don't have to give the huge discount. You don't have to do it at NTA. You can do it at the real market price. And that's sort of, again, a commercial discussion, but at least you've got that bandwidth from the dollar to the 5 cents to work in. And that's essentially value creation that you can use to incentivize, attracting, engaging, retaining quality team members when you don't always have enough cash to pay full freight salaries maybe in the first couple of years and stuff like that. That's kind of partly why it's there. Cal's also said here, do you commonly allow a discount to raise the price, to raise the price, given most employees don't have preference shares?
Most commonly you see it set by reference to NTA, because it's always, well, not always, but vast majority of the time it's the lowest value, and so it's the lowest value you can get away with and still fall within the CGT concessions for tax purposes. So
seems to be around like Series A, people start to reduce the discount because so much value is being created and the company is really standing on its own 2 feet. And so new team members coming in are much more likely to get a real market price, exercise price, and then share in the upside from what I've seen. But then, your really early rounds are quite often at the biggest discount possible because, you're looking to incentivize as much as you can.
Yeah. And look, I would generally prefer to adjust the value at at the number of interests granted level as opposed to at the exercise price level. But equally, you do take into account the fact that if you're getting someone to pay an amount in order to exercise their shares, that could be perceived to be the value by an incoming investor as well. So you've got to balance up that commercial versus what's ideal from a tax point of view.
We've got a follow-up question from Stephen, which I think is relevant for a lot of us. So he said, the issuing company can use the NTA price to issue shares as part of an incentive scheme. Well, I'm going to say options because everyone in Australia uses options if you're under the startup concession. So the answer to that is yes. So you can use the NTA for issuing options as part of an incentive scheme. Is it the same for shares versus ESOP? And it is, but I just think, well, Stu, do you want to just confirm that? And why do people use ESOP versus ESS under the startup concession? What's the reason everybody does that?
Well, options are far better understood, I think, and it's been more prevalent, and it's what was used in the US. But equally, there are requirements around the number of employees that you have to issue the grant to if you're using shares alone. So 75% of employees with 3 years experience 3 years employment need to participate or be offered. So what I would say is equity in shares versus an employee share option plan. The only difference in terms of what you would be looking at is in a share scenario, you need to provide a maximum of a 15% discount on the value of the share. So you'd still be using NTA to work out your top line market value, but then you would apply up to a 15% discount to the individual and still be in the startup concessions. Whereas the market value options, all you're doing is working out the NTA in order to determine what the exercise price is set at on the date of grant.
Gotcha. And the last bit of Stephen's question was, this paperwork needs to be done by the 15th of August. I think it's the 14th. Don't lodge on the 15th, Stephen. But can we just quickly talk about what they need to do for the tax office and what they need to do for the team members, and what is it and what's different? And
so that statement that you flashed up before, that's the piece that needs to go to the employee by the 14th of July. It was 15th this year only because it was on a weekend. So that's kind of similar to our payment summaries that we used to have. It's a
And they
state.
should put that information in their tax return, right? So we should be all
Correct.
communicating to our teams that they have this obligation and here's the information. So we're being good employers. And
Yeah,
at Cake, we always talk about over communicate so they feel like this is a great thing to have and that they don't have tax problems and that you're a great employer and that you've got their back and everything's under control.
yeah,
So, there's some really good insights there in how to stay on top of these things.
that's right. And then the report that needs to be provided to the tax office by the 14th of August is basically a synopsis of all of those different individual statements that have been provided to individuals. It's a summary of all of that information, which the ATO uses to pre-populate, pre-fill within the MyGov space, so that when people go in, look at their MyGov and start to do their tax return, they've already got the number in there saying this amount should be at this box in your personal tax return.
Sweet. How are we going for time, Stu, on the stuff that you wanted to cover?
I've got three more points, but they're really short and sharp, so I won't
Cool.
go into detail. Payroll tax, just wanted to call it out. The call out there is that payroll tax requirements don't necessarily always align with the ATO requirements. We haven't managed to harmonize that yet. So as an example, the net tangible asset valuation methodology for ESS purposes in some jurisdictions isn't allowable on the payroll tax front. So my call out there is be mindful that you shouldn't just be picking up the value that you're grabbing or that you're including in the ESS statements and putting that through your payroll tax return. If you're subject to payroll tax, you actually need to do an analysis around that. Second one was around, are these final numbers? And the answer to that is when you report on the statement, that doesn't need to be technically 100% what goes in the individual's personal tax return, because there are various factors which mean as an employee, you may not know what the real number is. And so we treat it as an estimate. That being said, you want to make sure that you're talking to your employee and hopefully getting it right so that when they go to lodge their tax return, you don't have discrepancy between ATO records and individual submission. So just be mindful of that. And then the last bit was just around when we come to liquidity, if we're in a startup concession plan, there is this 3-year minimum holding period that you need to have in order to access that concession. There is technically no ESS reporting at that liquidity event. However, it's important that if you are within that 3-year period between grant and sale, that you are going to the tax office and requesting the commissioner's discretion to be able to reduce that minimum holding period, because otherwise the participant loses access to their CGT discount. So again, when it comes to that liquidity, no ESS reporting, but maybe there may be a requirement to go to the tax office in order to get commissioner's discretion around minimum holding period.
Amazing. Thank you. So everyone, if you've got more questions, please put them in the chat. That was awesome, Stu. I'm now going to show you through how Cake solves this. And for those of you that are newer to this, seeing how this kind of actually works a little bit in real life is always good. And for the rest of you, you probably only do it once a year, so it doesn't hurt to get a refresher. If you need to jump, that's okay. We're going to have a recording. So I'll just share my screen. Again, chuck some questions up in the chat. We can come back to them after this run through. So the first thing I wanted to highlight was just our reporting features. So at a very high level, you've got a summary here, which is downloadable on the top right-hand side. If you ever need your full cap table, you can do that. And then within your incentive plans, obviously there's download features within here as well. For those of you that are on the Pro plan or that need it, there are like a range of additional more detailed reports available down here in advanced reporting. So between two dates, for example, quite a lot of us are looking for movement between two dates when we're handling our cap table. Or at date. So yeah, there's more sophisticated reporting in here for those of you that need it. And then this is the new ESS report that our customers were asking for, particularly, sort of once you get to sort of seed Series A and you're becoming a little bit more focused on compliance and you got, more professional team and needs. So yeah, there's a really nice report that comes out of there. So like most of the things in Cake, we try and empower you as opposed to, when it comes to these really technical items, you do need a combination of Cake and either the professional that's inside the organization, or you know, an outsourced professional like Stu. So I'll just share the screen. So what we've done in this instance is make sure that we've given you the relevant information to complete that reporting. So, you know, if you're doing these lodgements yourself, all the data that you need will be here. There is a couple of bits of data like the discount calculation that you'll need to do separately, because the actual valuation of the company isn't in Cake. So, you know, there's a couple of little bits that you need to add in when you do the report, but you know, we've made it as easy as possible. So either you're doing this internally, or you're working with, you know, with your accountant, you know, or consultant to get that ESS reporting done. Yeah, so what was I going to show? Yeah, the reporting. Oh, yeah, and then just finally, for those of you that are using Cake, we've just had a couple of new releases, so it's always nice while you're here to see what's happening. And most of our releases are requested by our customers, so it's likely that you're going to find these interesting. So particularly for the bigger customers, an audit log has been something that everyone's been asking for, because a broken cap table is a bit of a nightmare, and actually knowing what's happened and why and when is something that just came up again and again and again. So you can easily go in and you know, just see what's happened and make changes and corrections. So yeah, that was something that our bigger customers were asking for a lot. And then another thing was comments. So we've just added comments in, because there's a little bit of sort of metadata that sort of needs to be in part of the cap table brain, like what is it and why, and who's done what, and like, has there been some research done, and so yeah, that was something that's just been asked for a lot. So there's a couple of, you know, really interesting things that we've just done. And then finally, you know, I can't have you here without talking about communication, because we really want you to communicate well with your team so they feel engaged and connected to their ESOP and motivated. So for those of you that haven't seen the employee app for a while, or maybe don't even have their team members using it, just bear in mind that we have like really helpful content in here just to help them understand what the hell it all is. And if they don't understand it, they're not going to value it, and you're not going to get the benefits of it. They can also come in here and set goals. And it's amazing to see how powerful this kind of thing is. You know, that whether they're saving for holidays for their families, or deposits for homes, or whatever, it's really nice stuff. And I think it's just so cool to have a real human element around something like equity, to help you build culture and team. Yeah, so I won't go on too much. Of course, there's tons of stuff Cake does. I just wanted to show you a couple of things in case that helps. And while we've been doing that, we have a few questions. So for those of you that are here, you know, let's dig into these, because questions we find is normally helpful for everyone. Some of you might have questions that you don't want to ask, so it might have been asked for you. So all right, who we got here? Kaylee, thank you. So if an employee wants to purchase shares through a bonus issued, is there any reporting requirement? And are they still classified as an employee share for the 50 cap table limit for a private company, or do they take a spot on the cap table? So that's two parts to the question. The first one is shares purchased through a bonus. Is there a reporting requirement? And then the second part is, where do they fit on the 50 shareholder rule?
Yeah, so I think the answer to that is it depends, as with anything tax. So when you're talking about a bonus that's issued, if the bonus is essentially salary sacrificed, if you take a pre-tax amount and use that to purchase shares, there would be a reporting requirement there, because the pre-tax amount that is being used is not taken as being consideration for the purchase of the shares. So, you know, if you've got $100,000 bonus and you salary sacrifice it and you get $100,000 worth of shares, that $100,000 would still be taxable to the individual under the employee share scheme reporting provisions. The alternative is that you take the net after-tax bonus and apply that to purchase shares, in which case all you're doing is buying a CGT asset and there's no discount, so there would be no ESS reporting obligation in that scenario. In terms of the cap table bit, you might be more across that than I am, Jace, to be honest, but
Yeah, I mean, as far as I know, if they're a shareholder,
they're a shareholder.
they're in the 50. That's pretty much it. I don't know that there's any types of shareholder that are exempted. So I think, yeah, they'd be in there.
Yep.
For those of you that don't know, there is a concept of a bare trust. You can put some shareholders into a trust under certain circumstances. It's not like totally straightforward, but it is, really doable these days. So you can talk to us or Stu, and I'm sure he's got team members that can help you set those things up. So if you're getting close to 50 and you're trying to work out how to manage that, there are some ways you can use trusts for that. That's quite effective. So yeah, just let us know if that's interesting. The industry seems to be getting better and better at that at the moment. And then Jamie, thanks, Jamie. He said, appreciate that the session jumps straight into the common issues or challenges. Great. Any plans for Cake to build in financial reporting, share-based payment calculations? So financial reporting, share-based payment calculations. I'm not sure. I'm not sure, Jamie. You might need to. Yeah. So this is so that you can report your employee equity better in your financial statements, I think is how I would read into that, like under IFRS maybe. And yeah, look, it absolutely is. If that's what we're talking about, it absolutely is on the agenda. It comes up semi-regularly, not like super regularly, but oh, thanks, Jamie. Yeah. The bigger we get, and the bigger our customers get, the more it seems to be a need. I was only talking about it yesterday, with the product team. So I would imagine, yeah, in the next 12 months, it'll be there. It's just a matter of, priority. So one thing you can do to help your case is ask for it. Like any of you, because there could be 20, 20 or 30K customers on here. If you want this, like ping the customer success team, because the more you ask for stuff, the more likely it is. Like we've got a team that's constantly trying to build the most important stuff for you. So if you want it, ask for it, and you're very likely to get what you want, which is kind of cool. Next question from Tristan. Question on the NTA calc. If I have 250K in cash and a 200K convertible note, my NTA, is my NTA 250K or 50K? Ah, interesting. Interesting.
The answer is I normally send these queries to my valuations experts and
Yeah.
they answer it for me. But Tristan, what I can do is after the session, I'll find out the answer to that and ping you a note.
I would have to say the same thing. We have partners that do valuations because it's a very specific thing.
Yeah.
And yeah, I reckon we've got your email, Tristan, from registration. So we'll follow you up. I'll get Stu well, Stu's obviously already said he'll follow you up. So that's awesome. My understanding is a convertible note is debt and not equity. So it's
Yeah.
probably 50K.
Yeah.
But that'd be my layman's
Yeah. That's what I
understanding.
would
I
have anticipated
I
as
am an accountant, but not like not like a these things get pretty technical. So I think we should come back to you properly, but that'd be my guess. Whereas
well.
a safe is more like a safe is actually, I think, negative equity.
Yeah.
So you'd probably count it as 250, but let's get the experts comment on that for you. Um, and then Stephen again, nice one, Stephen. I have a technical consulting business with startups and scale ups as clients. Yep. How can I use Cake to help clients set this up? Some clients want to pay for some advice, warrants, options, equity. Yeah. Well, I mean, just hit me up afterwards, Stephen. So it's jason@cakeequity.com. We partner with tons of awesome advisors. We love to partner because software can only do so much and all this equity stuff is very complicated. So yeah, how we normally do it is I'll show you what Cake does. It's very, very helpful, streamline, simplify a lot of things. And then wherever we hit our limit, that will either fall to you, or then I can bring a partner in, like Deloitte or whatever's most relevant for you. And then as a team, we solve the problem that way. So hit me up, Stephen. I love solving things like that. So yeah, we can work it out. Cool. Well, I think we've covered all the subject matter for today, and that was great. I learned something. Really appreciate Stu coming and doing this and partnering with us. Yeah, really grateful for everyone's time. Yeah, if you ever need anything, let us know. This is recorded, and we're both going to be sending a little bit of content out, like a short summary of the important stuff for you to take away. But yeah, like it's complicated, so just hit us up and we can still help you out more. So yeah, thanks, Stu. Thanks everyone. We'll wrap
No.
it up for today.
And Jace, thanks from my side as well, mate. Do really appreciate the opportunity and thanks everyone for coming along.
More than welcome. So you've got 4 weeks to get this lodgement done. And if you haven't got your employee statements out, don't worry. I'm sure they'll forgive you. Get it out there and onwards and upwards. See you.